Okay, well, I'm going to welcome everyone to our webinar, Charitable Gift Planning 2025 and Beyond. First, before we start, I do want to say our hearts and prayers are out to those in Los Angeles, really those that are affected by the wildfires. And for today, we want to say mahalo to Hawaii Gift Planning Council, as well as Hawaii Community Foundation for hosting today's webinar and in-person meeting. We want to acknowledge the attendees on Zoom. And we're going to start off, and our webinar speaker will be Brian Janowsky. Brian is a partner at ArentFox Schiff LLP in New York. And he escaped the polar vortex by being here in Hawaii. So we're excited for him and his family to be here and present this webinar to you today. Brian's practice really focuses on wealth transfer plans for clients and always being mindful that clients' really non-tax goals for their families, businesses, philanthropic interests are the driving force behind any plan. Questions, if you do have any questions, please put it in the chat. This session is being recorded, and we'll send you the recording as well after the presentation in a few days. So without further ado, we're going to go ahead with Brian.
Well, thank you. And I am happy. Thanks, everybody. I appreciate the opportunity to be here. Thanks for inviting me. And just a second, Janelle's comments about the devastation going on in LA. I'm sure there are those in this room and those on the webinar who have family or friends who may be affected. And since we're here talking about charitable giving, I am certain now and in the days forward, there will be many opportunities and organizations looking for support. So if you have clients, donors that you're working with, and they're looking for ways to give, help them find the avenues to make those contributions at this very important time. And so today we're going to be addressing charitable gift planning 2025 and beyond. As a roadmap here, we're going to first talk about what we think is going to happen. I don't know for sure what can happen, but I can tell you what I think may happen in the coming years. Then we're going to talk about some interest rate sensitive planning for gift strategies and how those are impacted and may be impacted in the coming years as interest rates may adjust. And then last, we're going to talk about some pre-sale charitable planning for people with private companies. So here you're thinking about your donors, your clients that may be heading towards a sale, and maybe there's an opportunity for them to do some good for the community at the same time. So it is not a mystery that charitable organizations, like any for-profit business, have been struggling with the increased costs related to inflation and interest rates. So that is something that is ever present. On top of that, charitable organizations are dealing with what are always very fickle donors. To engage with a donor, you have to pick the right day, sometimes the right time to engage. I'll tell you right now, that's always after coffee, never before. And donors, they're very influenced by what they hear on the news, and more so what they read on their chosen electronic device about the state of the economy. That affects how they feel about their own financial well-being and directly affects their feelings about giving. And then tax policy. I like to think all the donors for your organizations are giving with their hearts, but ultimately some do look at the after-tax returns when they're thinking about how they give. And so tax policy always plays a central role in how donors feel about giving, when, if, and how they want to do it. And tax policy can shape that quite a bit. So I know we're going to talk about 2025 and beyond, but I think we all recognize that history is always the best teacher and can tell us a lot about the future. So it's important to understand where we were in Trump 1.0, as I'll put it, and then we'll talk about where we might be in Trump 2.0. So recall back in 2017, the Tax Cuts and Jobs Act was passed. It was the great accomplishment of President Trump in 2017. And it did a few things that impacted charitable giving. First thing it did is it decreased individual tax rates. Then it increased the standard deduction, essentially doubled it for individual married couples. The third thing that happened was that it doubled the available exclusion from estate and gift tax, meaning that families could shelter a lot more assets from the estate tax than they could in prior years. It's actually at an all-time historical high. Okay, so all of these have a slightly negative impact on donors when they're thinking about giving. And we'll handle these one by one. So when the tax rates are lowered, it's great for our donors, it's great for our clients, but it also actually lowers the value of the deduction. It's just a natural consequence. The larger culprit, though, has been the doubling of the standard deduction. Because in order to take a charitable deduction as a donor, you need to itemize. So if you're not itemizing your deductions, you can't take a charitable deduction. And if you're a married couple and you have a $30,000 standard deduction, you may be doing that over your itemization, which means that there's no benefit to you any longer making that $100 contribution, that $500 contribution. You can't take the benefit of that deduction anymore. And that can disincentivize people from giving when they otherwise would. And I think everyone in this room would agree, we all love to get the big check donation from that mystery donor, wherever they might be. But you're more likely to be getting these small donations. The small money donations mean a lot more to most organizations, so they come more often. And this in and of itself has stopped a lot of people who were giving to stop give because they didn't have the same benefit. Estate and gift tax exclusions, okay? Under the current law right now, every individual in this room can shelter up to $13.99 million at their death or during life from the estate and gift tax. So a married couple can effectively shelter $28 million from tax. Well, what did that do? That shifted the focus of a lot of families who were using charitable strategies as one way to reduce that tax impact, right? So if you no longer have an estate tax, maybe you don't think so much about that charitable bequest that you were thinking about before. Maybe the kids, hey, we could really use that money. The charity doesn't need it anymore. There's no tax. Let's change the plan. So it's shifted the viewpoint and the planning strategies quite a bit for families who now are covered from the estate tax. Then we get the pandemic economy. So in 2020, the government reacted as they should have and helped protect our economy by flooding it with capital, purchasing assets, and freezing interest rates. Okay, they're nearly frozen at 1% or lower. And I actually remember at one point, I think in Japan, interest rates were negative. I don't even know what that means, but it sounded weird. Okay, they had negative interest rates. So on top of that, with this economic stimulus that the government was pumping into the economy and buoying the financial systems, the stock markets ballooned. They hit all-time highs. So you had this weird dichotomy of effectively the wealthier getting wealthier, and yet individual would-be donors were struggling, worried about their jobs, how they would get to work, would they be sick? All these issues were coming to a forefront. So while we would typically expect economic performance to result in more charitable giving, people feel like they have bigger bank accounts, that did not necessarily occur. Okay? Tax policy was not really rewarding people for that additional giving. Interest rates were so low that it negatively impacted some of the planning strategies we like to use for our clients. So you couldn't even implement some planning strategies because of the interest rates. And let's just be honest, people were just scared. They didn't know what was going to happen. They didn't know what it was going to be like in a post-pandemic world. They were not just going to start giving away their capital to organizations without some level of comfort. And there were a lot of no's. So giving sort of dropped because of that. Now we're here today in January 2025, excuse me. Not too far away from Trump 2.0. It's coming. Get ready. Not quite there yet. But what is going to happen? What do we know is scheduled to happen in 2025? You might recall that when the tax law was passed in 2017, the way it was passed required that certain provisions of the tax law had to sunset. And that sunset date is the end of the year. Okay, why did those provisions have to sunset? Well, when the law was passed, there was not sufficient votes in the Senate. You needed a supermajority or 60 votes to pass it and make it permanent. Because they didn't have the votes, what the Senate rules say is you can't pass a law that will negatively impact the federal budget or deficit for more than 10 years. So that results in the tax makers had to decide which provisions were going to roll back automatically, right? That's why we're heading towards this sunset. And for those of you who are around and working during Bush 2, this same thing happened. 2000, 2001, new tax laws were passed. By 2009, 2010, 2010, things were rolling back and everyone was running around like the sky was falling. So what are the provisions that are going to sunset according to the law? Individual tax rates are set to jump back up. The standard deduction is set to be cut back where it was with inflation adjustment. And the estate and gift tax exclusions are also set to be cut in half. So does this mean sunnier skies for charitable giving? Do the incentives come back? Is there a stronger pull for people to try to reduce their tax burdens through charitable giving? Well, that is an unknown at this point, because during the presidential campaign, soon to be President Trump, president-elect, had two priorities on the campaign. One was immigration and one was tax policy. And so on a tax policy front, he promised to extend the 2017 tax laws. Okay. On top of that, he decided that he wanted to exempt tip income from taxation. We can have a whole presentation on the policy of that, whether that's a good policy, but I'm accepting tips after this presentation, and I will not be claiming them. I will not be claiming them in anticipation of this. And the other thing that President Trump promised to do was also lift the state and local tax limitation, the deduction limitation that was put in as part of the Tax Act. So if you recall, you used to be able to deduct all your state and income taxes and your real estate taxes against your income, which is a huge benefit. And Trump and the Republicans in 2017 saw it as a benefit that mainly helped states like New York, California, Hawaii. They did not help states like Alabama and Texas, where they didn't have large tax burdens at the state and local level. So in order to get votes, though, he decided, hey, we want to do away with that. So these are all really expensive propositions. If you believe that there's a such thing as a budget and a deficit and debt at the federal level, if you believe that, then these extensions are really expensive. And so it is not clear from the administration how they're going to pay for these extensions. So if there were to be an extension of the Tax Act, how long would it be? Well, because of the expense, and in order to get enough of the fiscally conservative Republicans on board, we are hearing that they're going to aim for something around 4 years as the extension. So it's not going to be another 10-year kick the can. I don't think the federal government, if you believe there's a deficit and we could go bankrupt, that they could afford to do it. It literally just they couldn't afford to extend it any further than that. And that coincidentally takes our soon-to-be president through his next full term, and it becomes someone else's problem to deal with. So you can see the attractiveness of that extension. So when might this happen? So as we discussed, the top priorities are immigration and tax. So President-elect has indicated that he wanted to deal with these issues in one snowball of a tax bill or legislative bill. The reason for that was he wanted to pin fiscally conservative Republicans against the wall and say, you want immigration reform, you also have to take my tax cuts, and force them to sign off on things they might otherwise argue about. And he was very strong on that until there was sufficient pushback in recent days from Republicans on the Hill. And that plan has now changed, and now they're going to attack these issues in two separate bills. We would expect that immigration reform would happen pretty quickly after the inauguration and would happen without a lot of arguing amongst the Republicans. That'll happen fast. The tax provisions are going to end up in a second bill where you're going to see the true colors of one party in terms of how they operate within each other. But you're going to see the traditional fiscally conservative Republicans fighting tooth and nail to not give these tax cuts or limit it to the extent possible. So we can't tell you when it will happen, what it will look like. But I do believe that Republicans are on enough of the same ship sailing in the same direction. They will come to some agreement on an extension. What it will look like, what provisions will sunset or continue, that's to be seen. But we do expect some extension of that tax bill, which may not be great news, as we already discussed, for your clients or your donors as they're thinking about what's the value of my charitable gift when it comes to taxes. Okay, but there are some positives that have happened that are still out there for your donors. Okay, late in 2024, Senator Langford from Oklahoma, he introduced a bill that would allow for people who take the standard deduction to still get a charitable deduction. So to get best of both worlds. It's equal to 1/3 of the standard deduction. So if you're a married couple with a combined $30,000 standard deduction, that means $10,000. That means a married couple taking the standard deduction could give $10,000 to charity and take a deduction for that, even if they're not itemizing. It's a really smart idea. It's so smart that 23 other senators co-sponsored the plan, Democrats and Republicans. And that's almost a quarter of the Senate. So we'll see where that goes. But keep your eyes open for that, because that's something that if donors don't think they can get the advantage, that law passes, suddenly all those small dollar donations can come back. And you can tell people, hey, you're going to need the deduction. Send out a news flash, do a newsletter. I'll do one, I'll send it to you. You can send it to your clients. No problem. And then you still have the IRA rollover deduction, which is really an incredible benefit to donors who have large retirement accounts, who don't need that RMD coming out to them. And this provision still allows your donors to actually shift up to $100,000 a year out of their taxable income directly to the charity's pocket. And it doesn't matter whether that taxpayer is taking the standard deduction or itemizing or subject to AMT and all these other tax things that are going to put you to sleep. But they get that $100,000 never touches their income tax return. It just goes right from their IRA right to the charity. And they get the full benefit of that $100,000 not going into their income. So that's still an opportunity for you to discuss with your clients, with your donors. Okay. So that's where we see things going in 2025 and beyond. And now we're going to talk a little bit about interest rate sensitive giving. And what we're talking about this is because the policies of the next administration are going to influence interest rates. Inflation is going to influence interest rates, and that also influences the type of planning that a donor may come to you and say, I want to implement this. I talked to my lawyer. I want to include you in my planning. Or in the best case scenario, you don't become an expert coming out of here. No way. But do you know enough to say the words at a meeting to create interest from a donor? Hey, oh, okay, maybe I'll talk to my attorney or my accountant. I'll figure out whether this is an opportunity that makes sense to me. So the focus of this next part of the presentation is on charitable remainder trusts and charitable lead trusts, and we'll get into the differences. We're discussing these because these both rely heavily on interest rates, specifically the Section 7520 interest rate. So this is the interest rate the IRS publishes every month, and it's used to determine either the present value of a remainder interest if you have a charitable remainder trust. So what's the present value of the gift to charity, or the present value of a annuity interest retained for a charity if there's a charitable lead trust, so the lead interest for charity, okay? So these are very interest rate sensitive giving techniques, but they're also commonly used. And so the interest rate environment will impact what you're suggesting to your clients or to your donors. And we already reviewed this. During Trump 1.0, interest rates were at historical lows. At one point, down to 0.4%, the 7520 rate. Now it's going to be Trump 2.0, and interest rates have climbed almost five times. And so it's a different environment than he was in at the end of 2020. So what does it mean? And just for your curiosity, this is a chart where you can see the changing 75/20 rates. And you can see in 2020 how the rates started around 2% and plummeted throughout the year, and how things have come back as inflation hit in 2022, 2023, 2024. So right now, the interest rate that we would be using if we were doing planning is 5.2%. That's the January 2025 interest rate. So I'll give you a few simple examples of how the interest rates impact both of these strategies. So briefly, charitable remainder trust, donor puts money in trust, retains an annuity for a term or life. The balance remaining goes to charity. So it's a remainder goes to charity, remainder trust. In this example, we have a donor who's 60 years old who puts $1 million into a charitable remainder trust, and it pays a 5% annuity for their lifetime. So let's look at the interest rates and the impact on the calculated charitable gift. When the interest rate was 0.6, okay, the value of the charitable deduction to that person was $5,000 from putting $1 million into the structure. And then if you go down, you'll see at 5.2%, the charitable deduction is $378,000 and some change. Okay, so this number on the right-hand side is the number that your client or your donor can put on their tax return as a charitable deduction. Okay? You can see the impact of interest rates when you have this strategy. Note that when the rates were so low, you couldn't even implement these structures for a lot of clients, because one of the rules for a charitable remainder trust is the charity has to be at least a 10% remainder interest based on the value of the assets contributed, that'll at least measured at the time of contribution, that has to go to the charity. So $1 million gift needs to have $100,000 remainder. So because of the low interest rate, this person couldn't even do it. You wouldn't do it anyway. But at 0.6, a 60-year-old with $1 million couldn't do a charitable remainder trust. They didn't qualify. And I ran the numbers. This person would have to be 67 and a half to get over the $100,000 hump. There would still be some issues with qualifying, but that's the closest you could get. So that's the basics of charitable remainder trust. Now we're going to flip to the charitable lead trust, and you'll see some different numbers here. The charitable lead trust is the flip of the remainder. In the charitable lead trust, you're giving the charity an annuity interest, right? The charity gets the lead annuity interest for a period of time. When that time lapses, the balance goes to the donor's heirs tax-free. So it's an interest rate game. If the assets in the CLAT beat the annuities over the period of the trust, the balance will pass on to the donor's heirs tax-free. Okay. At 0.6, you can see that the value of the charitable lead interest is $939,000, essentially the whole thing. Okay. Now, the difference between $1 million and the number you see on the right side of the screen, that is a taxable gift that's made by the donor, because that's the value, the remainder of that, the balance, that's a deemed gift to his heirs in the future. It's the current value of the future gift to those heirs. So the gift at 0.6 is really about $60,000, right? At 5.2%, right, that gift is up about $380,000. So the interest rates here have a big impact on the value of that remainder that passes to the non-charitable beneficiaries. So the sort of lesson here, very basic. Interest rates high, charitable remainder trust, good. Interest rates low, charitable lead trust, good. Interest rates high, charitable lead trust, still pretty good. And we'll get into that. So let's go through a more specific example of a charitable remainder trust so you can kind of get a flavor for this. The first thing I'll get on my soapbox. I don't have one here, but I'll stand up taller. You get a lot of clients who call you or call me, and I was somewhere at the country club, and someone told me if I put my stock or my family business or my vacation home into a CRAT or a charitable remainder trust, I can sell it and no capital gain. I avoid capital gains taxes. It's a very common thought process. It is just not true. It's a myth. A CRAT or charitable remainder trust is very good at deferring the capital gains tax and spreading it out over a long period of time. Okay. because when that, as we discussed, the donor puts money in and takes back an annuity interest, right? Here, in this example, it's 5%. That'd be $50,000 a year. As that $50,000 a year gets paid back to the donor, part of that $50,000 is going to be ordinary income if the trust in that year had ordinary income. Part of it is going to be capital gain, a slice of the capital gain that was originally recognized when the assets were sold, right? And then the balance of that 50,000 may be a tax-free return of capital or basis. So you are paying the capital gains taxes. It's just spread out over a longer period of time. It is not tax avoidance. If it was tax avoidance, the IRS wouldn't allow it. These are sanctioned. The IRS publishes their own form of a charitable remainder trust in the tax code. You can pull that out. They like these things. They're not worried about them. So don't think that you're really playing a lot of games here. But let's walk through this quickly. So donor here puts in $1 million. It's at today's interest rate, 5.2%. They take back a 5% annuity, so $50,000 a year. The biggest thing to recognize is in step 3. When you put the assets into the trust, the CRAT, and they're sold, the CRAT does not pay income taxes. We went through this. But what that means for the CRAT is it can take the gross proceeds of the sale and reinvest 100% into whatever else they want to invest in. So if in this case, this donor was only making 1.5% on the dividends, let's say he had one share of stock worth $1 million, was paying 1.5%. That's $15,000 a year. What this donor was able to do is put that $1 million of stock into this trust, right? Diversify it without tax, and now he's getting a 5% return, right? So now he's getting $50,000 a year. So it's a pretty good deal. And on top of that, the donor, based on the interest rates, is going to get a $378,000 deduction on their income tax return, subject to adjusted gross income limitations. We'll get there. Not too far in there because I don't want to put you completely asleep. But that is and then the upside for the charity at the end of the day is if the assets appreciate at 7% over 22 years. Now, 22 years is the actuarial life expectancy of a 60-year-old, according to the IRS. In Hawaii, it's probably 40 years from what I've seen. In New York, it's probably 15 years from what I've seen. So, but all things going well, the charity will get almost $2 million at the end of the day. And that's a pretty good deal. And this is more for visual learners, alternative view of the charitable remainder trust. It essentially describes the same thing we just talked about. And by the way, the amount of the upfront deduction the donor would get, right, the $378,000, the amount they can deduct from that number will depend on the type of charity that's at the back end. If it's a public charity at the back end or a donor advised fund, the upfront deduction is higher. If it's a private foundation, the upfront deduction is lower. One of the things with a charitable remainder trust that a client can do is they can actually control the end remainder beneficiary, so they can change it. So be nice. They can change the end beneficiary, but if they retain the power to change it to a private foundation, then their deduction's limited up front. Even though they may start with Hawaii Community Foundation, if there's flexibility enough to move it to a private foundation, then their deduction is limited up front. So if they really want to get the best deduction, they should be have a provision that sticks with a public charity or a donor advised fund. So flipping to the inverse, which is the charitable lead trust. Here, same facts, essentially. Donor is putting in $1 million, but as we discussed, the donor retains nothing. The annuity goes to the charity, right? So call it a 5% annuity for 20 years. That's the maximum time for a charitable lead trust, so 20 years. So that's $50,000 a year. And as a result of that contribution, the interest rates tell us that there's been a taxable gift about $387,000. So the donor would have to get their CPA together or their lawyer. They have to file a gift tax return to show the gift of that remainder portion of $387,000 and change. The charitable lead interest, the current annuity interest, the discounted value, is valued at $612,000 and change. Okay, so that number, the 612, that is deductible for gift tax purposes, right? not necessarily income tax purposes. Okay, there are certain structures that are more exotic where you can get there, but more likely than not, it is not deductible for income tax purposes. But the way that a charitable lead trust operates is when it distributes the annuity to the charity, it gets a dollar for dollar deduction against the trust taxable income. Okay, so that, let's say that the charitable lead trust earns $40,000 a year in interest and dividends, and it pays $50,000 a year to the Hawaii Community Foundation, as an example. That trust gets a dollar for dollar deduction. There's no tax every year. There's just no tax. If this same donor was already giving $50,000 a year to a charity of his choice or her choice, they may be coming up on limitations on their adjusted gross income, or if they itemize deductions against AMT issues. Again, I'm not going to explain AMT or else we'll all be asleep, but it allows for 100% deductibility for money going to the charity. Okay, so what happens as a result of this planning is if the assets grow at 7%, right, the charity's gotten $50,000 for 20 years. The kids, if we're assuming the kids are the beneficiary, when mom passes, or I mean, when the term ends, the kids are going to get $1.8 million estate and gift tax free. Right out the door. So one of the things that you'll see where these are actually really helpful, if you have donors who you perceive that their kids are already well taken care of and maybe not deserving, and your donor does not like estate tax, right? What you often see in more sophisticated testamentary planning, this lead trust here, this is lifetime, did it during life. Testamentary plan, a plan that's completed at death through the estate plan, you can create a CLAT or a series of tiered CLATs. And by tiered, I mean a 5-year, a 10-year, a 15-year, a 20-year CLAT. And you can create a scenario where you can essentially almost zero out someone's estate tax bill, right? So at death, no estate tax, and then these charitable lead trusts start working and charities start getting paid. And if investments are good, as the terms end in these various trusts, 5, 10, 15, 20, the heirs are getting money in those intervals. So if they've already blown through the money given during life, they have a second shot at recovery or retribution. I will say the one difficulty you find in this planning is finding a family with kids who are willing to wait for the money. But it is a pretty powerful idea. And so you see a lot of class in the testamentary side because there's got to be charitable intent, number one. This isn't all focused on the kids. But if they're trying to reduce taxes and do it in a way where there's a gap of time where nobody would be starving, it is an interesting idea that we see it quite a bit. Again, this is another, for the visual learners, representation of the same thing. And can we send the slides around? Okay, if people want them, you can ask for the slides. And because we talked about adjusted gross income limitations, I did create this very simple chart. This is not comprehensive. It's just a reminder that depending on the type of asset contributed and the type of recipient organization, the tax deduction changes. So it's a general matter, public charities, donor advised funds get a higher deduction. Contributions to private foundations get a lower deduction. So now we're going to jump into concepts of pre-sale charitable planning for private companies. So why am I discussing this? Well, with a new administration and with a perception of interest rates going down and with promises of deregulation and with cutting of red tape, big corporations and private equity firms are ready to go out to market and acquire new assets. It is going to be, we perceive it's going to be a very busy year for M&A work. As a law firm, we look at that, like, do we need to staff up? What do we see coming down the line from our clients? People are ready to go, which means that if you have donors who have private companies and they've been waiting to sell because nobody wanted to buy when interest rates were very high, this may be a coming environment where you'll see donors who are, maybe they are going to exit. Maybe there is a good offer now or a better offer than they had before. And you want to try to get in front of them or at least listen and hear if there's an opportunity. because you can actually help them do quite a bit of good with their transaction by taking some shares off the table for your organization before the transaction happens. So it's just something to keep in your sort of your quiver of tools when you're talking to donors. You know, hey, you have a company, you're going to sell. Let's talk about that. Talk to your lawyer. Let's think about, could we help you save some taxes down the road? And I'll give you a quick example. So this is Hawaiian Tropical Ice Company, and it's looking to get acquired. The founder, Sue, also wants to fund some improvements to some local parks where she first started selling her Hawaiian Tropical Ice. So she believes she can get $25 million for her company, and she wants to donate $5 million after the sale. So Sue's tax basis in her company is $3 million. And if she sells it between Hawaii and the federal government, she'll pay about $6.6 million of capital gains taxes. So Sue comes out about $18.4 million. And then she takes $5 million and gives it to the charity for the park's development. And she's left with $13.4 million. Everyone's happy. Sue's happy. Charity's happy. But Sue may not be so happy if she found out that maybe she could have gifted to the charity ahead of a sale 20% of the company. Because what happens when she does that? Well, the charity would receive the same $5 million as opposed to a contribution. It would be sales proceeds. But the charity doesn't pay any income taxes, right? Sue's capital gains are now based on her 80% ownership. So that's about $5.28 million. And that leaves Sue with $14.72 million in her pocket. So she's gotten better by $1.3 million. The charity's in the same place, right? It's sort of a no-brainer. So why isn't everybody doing it? A lot of people do this. A lot of people also make mistakes while doing it. And this is an area where the IRS has been very litigious. A lot of cases in recent years on issues related to pre-sale planning in this area. And so you need to be very strategic with your donor. If your donor shows up and says, I'm selling my company tomorrow, I want to give you 20%, you take it. And then later you say, maybe you should talk to your tax attorney. But the charity shouldn't worry, but your donor should worry about the timing. The charity in these cases that we're going to review is never at issue. It's the donor's tax deductions. So what are the issues here? Prearranged sale transactions. You can't transfer the company a day before the sale. You can't give to the charity and then turn around and sell the company. That's because of a concept in the tax code called assignment of income. And what the IRS says is if you're so close to the sale, to the contract, that it's almost a guarantee it's going to happen, there's no risk, right? Everything's ready to go. The day before, the hour before you walk in, you transfer to the charity, and then you sign the closing documents. They say you assign the income to the charity. So the IRS treats the donor as the owner for tax purposes. So the donor pays all of the capital gains on that transaction, okay? And it's a problem, right? They've lost the benefit. Now, on the other side, the charity, in these cases, they still got the stock. They still got the money. It's a donor who is getting punished a little bit here. And so we'll talk about a case where, like, how close in time can you be, right? There's a recent case that came out. That's a big question I get. Well, when, how long before? So that's an issue. Qualified appraisal, another area where the IRS is very litigious and is going after big donations. You have to have a qualified appraisal. If Sue wanted to get an income tax deduction for contributing her 20% to the charity, which she could have, she would have needed to go out and get a qualified appraisal. There are really specific rules under the tax code and the Treasury regulations about what that appraisal must say and who must give it. It's very specific and nuanced. And it's a very important thing. The IRS is winning cases right now where taxpayers have screwed up these qualified appraisals and denying deductions, and we'll get into that. And then tax issues. Not every company is the same. A client comes to you and says, I want to give you my LLC, no problem. I want to give you my S Corp. You say, oh, I'd love that. Let's talk. S Corps can be finicky. These are electing S corporations. Just beware. It's not as simple as it looks. So there can be tax issues. And then timing. This is sort of connected to the number one. But I mean, you get too far ahead of the transaction and there's no sale. What happens? Right? You guys accepted 20% of someone's company. You didn't think you're always going to be a partner. or you're gonna have to make decisions at board meetings, right? And the person making the contribution didn't really want you at the board meeting. And you can get in situations where organizations are tied together. And so if you're thinking about entering into and assisting with somebody's sale, because it's great for you, it's great for your donor, you need to have an exit strategy. Because if you're far enough ahead of the sale, you need an exit strategy, right? Because if you're far enough ahead, you need to worry about it. If you're too close in time, you're not worrying about it, you're probably too close, right? It's kind of a gut feeling. But we'll talk quickly about a recent case, the Hohenscheid case. And so this is a situation where the IRS, there was litigation, and the tax court found the contribution of stock to a charity was too close in time, right? So the donor paid all the capital gains taxes on the sale, and they did not get a deduction for putting the shares in the first instance. They failed on both fronts. So on the timing, this is just interesting. What the court said about the timing was that the buyer and seller in this case had already gotten all the regulatory approval required to move forward. They had notified all third parties that they were contracting with that they were going to have this transaction. They had distributed all their excess cash out of the company to the shareholders. If you have clients or donors with private companies, a lot of them sort of keep money in the company, out of the company. It's all their money, so they don't really think too much about it. But before a sale, it all comes out, right? So sort of the last step is you empty the company. And that already happened. There was a bunch of employees who had different compensation arrangements that if there was a change of control of the company, they were going to get paid. They paid all those employees. So they paid them out. And then there was only really one remaining non-material substantive issue in the contract that was left to be dealt with, but it didn't really impact the transaction. And so those were all the facts that led up to the court saying, no, too close in time. So the taxpayer turned around and said, well, at least I get this deduction. I did give them the stock. And the IRS and then the tax court really ripped the taxpayer here because their qualified appraisal was really deficient. And here's how it was deficient. The appraisal did not include a statement that it was prepared for federal income tax purposes. It had the incorrect date for the charitable contribution. It had the incorrect appraisal date. It didn't describe how the stock was valued. It was not signed by the appraiser. It was not prepared by a qualified appraiser because the appraisal did not lay out the credentials of the person doing the valuation. That's a prerequisite to be qualified. You have to have credentials. And they did not describe in sufficient detail the property that was contributed. So the taxpayer really lost everything here. Bad for the taxpayer. On the other side, they don't talk about the charitable side. The charity didn't get touched on these things, right? The charity still got the stock. They still got the sale proceeds. They still didn't pay tax on the sale proceeds. The donor actually ends up paying that tax on behalf of the charity because the charity got them. So not a great result. And this is where we talk a little bit about the qualified appraisal. You don't need to know a lot about this, but if you have a client who comes to you or a donor who says, I want to give you my house, I want to give you this share of the company, I want to give you this LP investment in this private equity fund, you need to get a qualified appraisal for that. And you should tell these donors, do not go cheap on that. You need to do it. You need to do it right. The IRS is going after this. And that appraisal needs to say certain things. It's all in the tax code. The donor also has to file certain forms with their tax return. And if the contribution is over 500 grand, they also have to attach the appraisal. Okay, this is a mistake. If you don't do it, you don't get the deduction, no matter how valuable the contribution was to the charity. And the courts and the IRS are viewing this really, they say there's substantial compliance, but they're really enforcing strict compliance right now, meaning that, if you forget to cross the T or dot the I, maybe you're good. But if you miss a signature on the thing, or you have the wrong date inadvertently, they're coming back and they're auditing these big contributions. They're taking your deductions away. And so there's another set of cases here. I won't go into it any deeper, but we're dealing with this in real time at our firm. One of our clients made a contribution of very valuable privately held stock. Let's say that they contributed 100 shares, okay? They got the qualified appraisal. They filed their CPAs are good. They filed the correct forms. They attached it. filed it on time. And the IRS pulled and audited, and they denied the charitable deduction. They denied it because the qualified appraisal appraised 1 share of stock. Now, the client did the math. 1 times 100. They denied the deduction because the appraisal did not literally describe what was given. Okay, this is going to go to tax court because the IRS is not giving up on this. They think they're going to win on that nuance, right? And so it is a high burden. And if you have clients who are trying to give to you, you can help them by suggesting, hey, get that qualified appraisal. I had this really scary presentation with this guy from New York. And he scared me into telling you that you need to get this thing, but you really should offer that to your donors. You know, send this presentation to somebody, scare them. But because these are mistakes that you just wouldn't think would be material, and the IRS is being very picky, and the tax courts are sort of going along. It's kind of unusual. You usually get a little bit more wiggle room with these little things, with these qualified appraisals, but it's been much more strict. So again, I think in this coming market, with the large companies and private equity firms coming and looking for new acquisitions, this is actually the place where I would think as a charitable organization, you'd be focusing on hey, just are you thinking about selling? If you were, there's all these opportunities to think about. That's going to be powerful opportunities for charitable organizations, I think, in the next year or two. And that's all I have. And read the instructions. So are there questions that I can try to answer? It's a lot of information. Okay.
I have a question.
Sure.
And so going back, I guess, to Trump 2.0, the bipartisan bill by Senator Langford.
Yep.
Is that what we used to call during COVID, the above the line deductions? Is that what it's bringing back?
Correct, exactly. So you're going to it's going to be, they would add a line item to the 1040. That would be above the line. Yep. So it would be a huge, and I think what they're seeing is it's not just charitable organizations in Hawaii, New York, California are getting impacted. It's everywhere. And those small dollar donations, just like in campaigns, they mean the world to smaller charitable organizations, because more likely you're going to get a $5 contribution than you're going to 5 million. Yeah.
Thank you so much, Brian, for that presentation.
Sure.
First of all, my name is Kyle from Salvation Army, and I've seen quite a bit of presentations where they talk about giving private business interests for the benefit of charitable organizations. But what kind of companies do you see this commonly for? Like small family businesses, or they, bigger LLCs, or commonly, what is the most likely scenario for something like this?
Well, it's a donor who's what we see in our client base is it's a typical scenario where it's a family business of some scale. It could be $1 billion family business. There's a family business of scale, and there's no succession plan. And so there's going to be an inevitable exit. Kids aren't in the business. They're not going to do one of these fancy ESOP plans. They're going to go to market and get out of the business so their family doesn't fight. And so, you're sort of trying to read tea leaves a little bit, but from a business type, there's no specific business type I see who does this. If it's a saleable business and somebody's looking to sell. Now, in terms of the S Corp LLC, that comes down, that takes all forms and shapes, and charities will work with a donor who wants to contribute an S corporation. There are different tax impacts from doing that, I'm sure that is counterintuitive, but C corporations, LLCs, limited partnerships, that's all good. Not big issues there. CS corporation, that creates a little bit of heartache for everybody.
Question.
Sure.
You spoke about CRATs, but we see way more CRUTs.
Okay.
So do you have a preference? I mean, like under what scenario would you see one over the other?
It's just a cash flow situation. The CRUT will float with the performance, where a CRAT will be kind of level. So that's really the main difference.
So you leave that up to the client?
Yeah, we usually, there's more than one slide of what this looks like. So it's
Right.
usually projecting out crat, crut, clat, clut. I mean,
Yeah.
I sound like I'm a chicken. But there's all kinds of ideas and different tax projections you can do. And even in the context of the charitable lead trust, there is some ability to get the income tax deduction up front. It's a much more complicated type of trust, and most people don't want to do it that way once they understand how the income tax deduction is earned. So I won't go into more detail, but you can get an income tax deduction with a CLAT, but it's just more unusual to see it.
You.
Mhm.
Okay, there's a question from online. Are qualified appraisals needed for gift tax returns?
So yes, yes and no. If gift tax returns require substantiation of value, and there is a whole set of regulations that deal with what does it mean to substantially disclose, adequate disclosure is what they call it, the value of what you put on the gift tax return. It is not as stringent as the IRS is enforcing on the income tax side. But yes, qualified appraisals are the best thing to get for gift tax return. They're the ideal, and most of our clients do get them. But you could come up with a different way to disclose your value, as long as it fully informs the IRS of how you did it, why you did it, the basis for it, so that they can pick it apart. If you put nothing, they're going to deny it. So you got to have some substantiation.
Any other questions? Okay. I think we're done with the presentation.
Cool.
So thank you very much.